Ticker symbol GRMN is up over 50% in the past year, and today we'll be looking at a company which has great efficiency ratios and, of course, the market leadership. It is a highly profitable, diversified stock which has managed to grow its operating income by 46% in the past year. And this company has solid revenue growth with consistent margins. So today we'll be looking at none other than Garmin, a GPS technology company. In their annual report, they state that they pioneered new products, many of which feature location technology such as GPS and other applications designed for active lifestyle. I mainly know this company due to their smartwatches, which I would call similar to an Apple Watch, but in my opinion, a lot better looking, and they have so many different options, allowing you to track anything related to sports. However, by looking a lot more into the company, I actually understood that these watches are only a very small part of their business, as they mainly design, develop, and sell many GPS-enabled products and other navigation and even sensor-based products. Now, the quality of these products is great. Of course, their prices are very high, but they're generally known for having a very high value, high performance, easy to use, and very appealing designs. I could categorize their products into 3 different sectors, starting with the first one, fitness and outdoor products, where they have, as I was telling you, their smart watches, their wearables, and even tech gear products for cycling, for golf, and other health and wellness accessories. So of course their main products are their watches, but there are also many famous tech products where, for example, you have a product which allows you to calculate the distance from where you are and where the hole is so that you know which club to use or which strategy to take next. Then they have a very large sector which involves in marine products, belonging to the different categories: navigation and mapping, sonar and fish finding, marine audio and instruments, and even autopilot and radar systems. And last but not least, they also have 2 categories focusing on aviation and focusing on automotive products. These include integrated flight decks and displays, autopilot and safety tech, data services, dash cams, and other performance tech. Where, for example, for the automotive industry, they have this sensor that you can stick into your car and it will tell you a lot of different performance indicators, measuring your average speed, how aggressive you are at taking the corners, how dangerous your driving is, and allowing you to either become a better driver or just use it for performance if you ever race with your car. And as we can see, their financials are incredible. They have a 21% return on capital employed, which is higher than our usual 15% threshold that we put for this ratio. Then they have an interest coverage ratio of over 100 times, meaning that they won't have to worry about debt anytime soon. They have a cash conversion of over 83%, and a gross margin of 59%, finishing off with a 22% net margin, which is again above our 15% threshold. As we can see, the revenues had been growing at a fairly consistent slow pace, but since September 2023 they actually started to take off, and their growth rate has been larger every single quarter. We can also see that their net margin was a lot higher from December 2023 all the way up to September 2024. However, in this latest quarter, it actually normalized and went back to where it was a couple of years ago, sitting at a solid 23%. And when we look at their efficiency ratios, these are normally more correlated to the net income of the company. However, which is why they have been growing consistently every single quarter from July 2023 up to now. However, what's interesting is seeing how these ratios were falling from June 2021 all the way up to December 2022. And it would be interesting to find out why this was happening to see if it can happen again. But I love this company's balance sheet. You can see that they basically don't have any debt. They like to be a non-leveraged company, and this is why their assets are way above their liabilities, and every single quarter that goes on, their current ratio is improving, which means that this company is very attractive to those more conservative investors. And as we can see, despite their total assets increasing at a fast pace, their total liabilities are increasing at a way smaller pace, which is why their current ratio is improving quarter after quarter. And when we look at their fundamental analysis, this company gets a very solid 7.5 ticks out of the possible 8. As they have a very low liability risk, as we have seen by their over 100 interest coverage ratio, then they have a very solid balance sheet as, first of all, their total assets are way above their total liabilities, but because they're able to pay all of their short-term liabilities only by using their current assets. And the thing I love about Garmin is that they're very consistent at generating free cash flows, which are growing organically. And this is mainly funneled by their organic revenue growth, which we saw previously. By organic, remember that we mean that this company does not need acquisitions or mergers in order to grow their top line. Additionally, this company pays a very stable dividend, which has been growing nicely over time. And when we move on to the two most important factors, their pricing power and their existing moat, I believe that Garmin meets them both. By pricing power, we usually mean the ability of increasing your prices at a rate above inflation for a very long time without losing too many clients. And in Garmin's case, I believe this is pretty simple. You can rest assured that whenever a client purchases a Garmin product, it's not because it's cheap. It's because they believe that it's the best quality in the market, that they need it, and that it will make their lives a lot better. This is a great position to be in because it's similar as Apple. Their phones are very expensive in comparison to the rest of their market, but their prices kept increasing and increasing and increasing over time, and people just kept buying these phones. Well, I believe that Garmin has a similar strategy. All these sensors, high technology for sports, wearables, smartwatches, and all of their other components or products produce the best quality. You can rest assured that they're incredibly reliable and they're very durable, meaning that if you buy one of these smartwatches, they will for sure keep working if you look on 5 years from now. This allows Garmin to increase their prices over time without customers actually complaining too much, because they know that these products are more of an investment than a cost. And when we look at their existing moat and competitive advantage, there is no other company in the market with such a wide portfolio breadth, meaning such a wide offering of different products, where all of them are actually the market leaders in every segment that it participates. And if you're a very active person and you enjoy a lot of these different sports, chances are that if you've purchased Garmin on any of these sports, since the customer satisfaction rate is so high, you will keep purchasing their brand for all the other sports that you perform. So what I believe is great about this company and generates its existing moat is the fact that they have very good brand recognition. Just by their name, you can see that this company is high quality, and if you ever test out any of their products, you will see it's best in class. And you do have to remember that this industry does not have low barriers to entry. You have to have a very good product, be able to deliver a lot of value to your clients, and when you're selling an over $300 golf watch or you're selling sonars or sensors for yachting and fishing, you have to ensure that you have a very good brand name and that people actually trust and know you, which is very hard to accomplish, and why I believe that Garmin is being so successful recently. However, there is one thing that I didn't quite like, which is the fact that they're not engaging in share buyback programs. In fact, their shares outstanding have been increasing at a small rate all these past months. And we can see that they're yielding a 1.32% dividend yield, which is rising at a very small and steady pace. In this latest quarter, we can see that they've had the lowest dividend yield that they've had in the past 4 or 5 years, but this, of course, is related to their valuation, as they're currently priced at the highest multiple that they have been priced over the past 4 to 5 years. And this is very consistent with their free cash flow yield, as they're currently yielding a 2.85%, which is lower than the 3% long-term inflation rate, where both these metrics suggest that this company may be overvalued at current prices. And when we look at the risk and possible challenges, I first of all see the worsening competitive landscape, where, of course, they're not the only competitor in this industry. There are a lot of other companies which may not be in all these industries at once, but which are also having very strong offerings in all these other segments. For example, in their marine segment, they're competing with companies such as Raytheon, which have been leaders in this industry with sonars and radars for a very long time. So they do have to keep an eye out for this, and they need to keep being innovative and providing the best quality that they can. And now the second risk that I do see is the cyclicality risk, or the risk for economic downturns. Because of course, a lot of these products are products that are not generally needed. You buy them when you're doing well, and you could consider them as wants. You buy this because you have excess income and you want to enjoy a little bit more on your hobbies. However, the moment that there is an economic downturn and people are less financially secure, these are some of the products that they will stop buying first because they're expensive and they're not needs. They're more geared towards hobbies. And now before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage. It is generating consistent, growing cash flows, and it has a higher return on capital employed. So this may be a good company and may be a good investment, however, it has a very high valuation to growth currently. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.